The market efficiency assumption is of key importance for understanding how to model financial markets. So how do we know whether financial markets are efficient? First, we need a model for pricing assets in the market. And then we need to verify the actual prices to see if they match the theoretical ones. If they're equal, we can say that the assets are priced correctly and therefore the market is efficient. If they're different, we would assume that the assets are mispriced and arbitrage trading has failed to correct these errors. So therefore, the market is inefficient. But it's not that easy. As we mentioned before, this is a joint hypothesis problem because different models for pricing assets will give different results. So we can't tell for sure whether the market is really inefficient or our model is incorrect. This issue has split finance scholars into two schools of thought. A rational school of thought, which works to model the financial markets based on rational human behavior, and a behavioral school of thought, which says people make errors in their judgment, and sometimes these errors persist over a time period. The studies on our irrational behavior and its influence on financial markets and the economy are evolving a lot. In 2017, Richard Thaler, a behavioral economist, won the Nobel Prize in Economic Sciences. And before him, two other behavioral finance scholars also won the same prize, Robert Shiller in 2013 and Daniel Kahneman in 2002. Their work have been a major influence in economics, from our understanding of the financial markets to actions we can take to improve public policies. Even Alan Greenspan, the highly respected former chairman of the US Federal Reserve, admitted to Congress in 2008 that the crisis had shown a flaw in his conceptual framework of the world. The model did not account for the irrational behavior exposed with the crisis. We've seen how emotions like fear or greed can make people behave irrationally in bear and bull markets. And even though there's no current model to help us time the market, and nobody has proved to do it consistently, there are increasing attempts to model our irrational behavior. For example, we briefly mentioned market momentum when we talked about multi-factor models. There are specific studies that suggest that in the short term, we underreact to information. So the winner stocks will tend to keep winning, whereas loser stocks will tend to keep losing. And this persistence or momentum can be exploited. Other studies say that over a longer holding period, there will be a reversal of this effect. So the winners will eventually lose and losers will win. This is called a contrarian approach. Even though there's some evidence that underreaction and overreaction exist in the market, they are hard to exploit. Sometimes it's difficult or costly to take the positions. The discounts may also widen before they narrow. It will be very interesting to see how the behavioral models will evolve in the future. I also want to take a more simple and qualitative approach to market efficiency to help us understand some of the active investing strategies available. Let's define three increasing levels of market efficiency: weak, semi-strong, and strong. If we say that the market efficiency is weak, current prices will fully reflect all the information incorporated in past prices. So it would be hard to use technical analysis tools that look at past prices for a stock and tries to predict what tomorrow's price will be. If market efficiency is semi-strong, all current prices fully reflect the information in past prices, and all publicly available information today. So it would be hard to find mispriced assets by doing a fundamental analysis of a company. And finally, if market efficiency is strong, current prices fully reflect all the information in past prices, and both public and private information available. This is obviously not true, and there are numerous cases where people have profited from this strategy. But insider trading is also illegal, so it's not a viable option. As a concluding thought on market efficiency, even though we see periods of inefficiency in the market in the short run, it is generally believed that markets have at least semi-strong efficiency over longer periods of time. And the rational models that we discussed are still the best models that we can rely on as individual investors. Even though they're not perfect, they're close enough. The short-term mispricing of assets is really hard to exploit. There are many hedge funds and other institutional investors playing this zero-sum game where one needs to lose for the other to win. So think twice before spending your valuable time on short-term trading. Remember, you're competing against players that have a lot more resources than you do. Chances are you're not going to be on the winning side of that game, and you would probably be better off with a longer-term investing approach.